Hello traders, Gary Wagner here. It is 12:50 in Honolulu, 5:50 in New York on Wednesday, 22nd day of February 2023, and this is the daily report for gold and silver. With only 2 days remaining for trading in the month of February, it is almost a certainty that the correction that we have witnessed over this month has been the deepest correction since the rally that began in November the 3rd and cements the stern understanding or shift in market perception that the Federal Reserve's monetary policy will remain hawkish, including more rate hikes and an elevation of those rate hikes probably throughout the entire calendar year. Because according to James Bullard, we are in danger of falling into a 1970s style inflation without aggressive rate hikes. This, of course, led to lower gold prices and a higher dollar. Gold today lost $8.30 or 0.45%, and basis the most active April contract is currently fixed at $1,834.20. The dollar reciprocally had some strength, gaining 0.36% or 37 points, with the dollar index currently fixed at 104.485. Lastly, silver gave up a healthy 1.76% or 38.5 cents, with the most active March contract currently fixed at $21.50.5. This first chart is a monthly candlestick chart of the continuous contract of gold futures. As we talked about yesterday, it is almost a certainty that the gains we saw in January would be completely taken away by the decline seen this month. That actually occurred today. We currently have April gold at $833.60, which is just below the opening price of January 3rd, the first trading day of the year. We are acutely aware that recent moves in the financial markets, including gold, have been 100% headline event driven. That being said, there is a solid purpose for technical indicators, specifically now in regards to the current price decline that we have witnessed this month. We traded to the highest value of the year this month and had the steepest decline since the beginning of this rally on November the 3rd. And where this correction concludes is an unknown factor. But one thing is critically important on a technical basis, and that is that the conclusion of this correction must end before the last higher low that was achieved back in December. The reason being is the characteristics starting in March 2022 was a series of lower highs and lower lows, as we spoke about yesterday. We then had our triple bottom and a pivot from bearish to bullish. The way we describe that in terms of a technical manner is that a uptrend is a series of higher highs as well as higher lows. This now being the deepest correction of the year, gold must trade to a higher low than the last higher low to confirm that this decline we are currently in is a correction and not a pivot or key reversal from a bull market to a bear market. That being said, we have plotted different areas where we believe gold could actually find support, but we also have to realize that it's most likely that there will be continued selling pressure based upon the release of today's minutes and up until we get data that suggests otherwise, meaning an inflation report that shows a dramatic decline in inflation or some geopolitical event that kind of turns everything around where market participants begin to focus upon events rather than Fed events, we will see gold either trade sideways or lower. 1800 is really my rough line in the sand because that keeps us above the series of lows that came in. And if that occurs, that would give us solid technical evidence that this decline down to 1800 is a correction and not a key reversal. This has been Gary Wagner wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.